Separately managed accounts are becoming so much more popular very quickly. So I wanted to run through what these are and how they work and the good and bad side of them. So here we go. First things first, what are they? Well, separately managed accounts are portfolios of securities that are managed by professionals on behalf of an investor. Well, what does that sound like? Isn't that what an advisor does? Well, kind of. Okay, so SMAs are separately managed accounts are designed to meet specific goals and preferences and can be customized to suit the investor's needs. What does all this mean? Well, think about it like this. They originated mainly for super rich people. And, I got $1 billion I need to invest. Well, I want to go find the advisor that really is good at this kind of portfolio and put some over there. And I want to find another advisor that's really good at this kind of portfolio. I'm going to put that over there and this one over here and this one over here and this one over here. Because one advisor can't really know everything about everything. So you want to find the ones that are the best to do this and the best to do this and best to do this. And so they started calling these separately managed accounts. The advisor doesn't necessarily have a direct relationship with you per se, but they've been told this is how they want this part of the portfolio and invested, and they're the experts, so I want them to manage that part of the portfolio. So 2018, there was $1.4 trillion in SMAs. Then by 22, it was already $2.3 trillion, and they're projecting 3.6 in 2026. So a couple more years. So we're talking 150% growth over those years, a few years. And so it's important that we kind of get a feel for these, because what used to be just for super rich people is now commonplace everywhere. And let's see what they are and how they work and what the advantages are. So what are they? Let's start with this. So the ownership is different, okay? You actually own the direct investments individually. So think of it as a mutual fund, except in this case, it's a mutual fund for you, and everything the mutual funds own, you directly own. People may or may not realize, but when you own a mutual fund or an ETF, you don't actually own the underlying securities. Okay, that's not how those work. And there's some fundamental issues with that from a mutual fund standpoint, whereas an SMA, it is a good thing that you own these directly. Customization, well, again, a lot of these were created for very wealthy individuals. And so it was literally created for that person's purpose so they could tell them what they want and don't want. So customization is very natural in here. Now, we're opening it up to the rest of the world, so a little less customization is possible if you have less money, but the more money you have, the more you can demand customization. Asset classes, wide range of securities, okay? Fixed income, equities, cash, anything in between can be used in these. Tax management, here's where the advantage is. When you own the funds directly, when you own the individual investments directly, you can do tax loss harvesting. You can't really do that in a mutual fund. Okay, so tax loss harvesting will help out quite a bit if this is non-qualified money. This is after-tax money you're putting in these types of funds. That is a good thing. Professionally managed. Again, the idea of this is take the expert in this one thing, dividend portfolio or whatever, one type of investing. I want an inflation hedge, and they all they do is study that all day long and invest the portfolio to be an inflation hedge. So you're looking for that professional management. You want that expert that is doing that particular thing, and that's all they focus on. And then investment objectives designed to follow a specific asset class, achieve a targeted investment objective, whatever the case may be. You can find a lot of everything out there, and or if you're wealthy enough, you can create your own, okay? So when we look at pros and cons on this, the pro side, direct ownership of the securities is, without question, an advantage. That is a good thing. And because of that direct ownership, you can manage taxation. Okay. Can be customized. Okay, so that's always good as well. When you buy a mutual fund, you can't call the mutual fund person and say, hey, I don't want these types of investments in there, or I want to minimize dividends because I don't need the income and I don't want the taxation. You can't do things like that. Okay, these are much more transparent than mutual funds. If we're gonna, if we're gonna compare these to mutual funds or ETFs, these are more transparent. You don't see the fees for the golf game they played today to talk business on the golf course. You don't see those fees in mutual funds because they don't spell them out, but that happens every day. Okay, so also they've reportedly over and over again, I've seen it several places now, they have the ability to outperform the benchmarks. And I do understand the technical side of this, but I'm leaving that wide open because they have the ability. They may outperform the benchmarks. A lot of this will have to do with the fee structure in there, right? If you have multiple layers of fees, and sometimes these do. So we have to be careful about the layers of fees, but there are reasons that these outperform mutual funds quite often. They will outperform mutual funds if the fees are under control and if they are properly managed. There's no question of it. They're more efficient. They're more efficient from a taxation standpoint, and they're more efficient from a fee structure, again, if it's a good, clean, honest fee structure, okay? So then the cons. You may need to be rich to invest. So here's the thing. There's a whole bunch of glorified SMAs out there. A lot of the big trading platforms are starting to put them on there for anybody. I mean, we're talking $15,000 minimums. Well, I mean, it used to be $150,000 minimums at minimum, right? Think about that. So you don't have to be super wealthy to invest in these now, which means a lot of those are going to be cookie cutter. There'll be specialty investment funds, but they're going to be cookie cutter. You're going to own the investments directly. Think about this. I'm an advisor. I specialize in this. I'm going to create a special portfolio. And then anybody that wants to, be a part of this portfolio, well, basically, I'm going to have separate accounts and I'm going to trade every single one of them the same. So I could have 150 million different clients, all with their own separate accounts, and every account's going to be traded exactly the same. So that's kind of what a mass-produced SMA is, a separately managed account is. So think about it like that. Now that we're mass producing these, we got to do it to scale. You're going to have a lot less of that customization. Fees. Okay, look, here's the thing. I've seen these abused quite a bit. So you have an advisor. They want to put you in an SMA. Okay, maybe you need a little bit of specialty investing, or maybe your advisor is just lazy. Because trust me, there's both out there. One that has a legitimate reason. Hey, this is a specialty portfolio. I want to have somebody that really knows what they're doing. I'm willing to pay a little extra fee for that. That's fine. Okay. You'll see fees anywhere for legitimate SMAs out there, anywhere from say 0.1% on up to 0.4, 0.5%. Have I seen a lot more? Sure. Sure, I have. But the legitimate ones out there are anywhere from 0.1 to 0.4 typically. 0.4, yeah, I haven't really seen too many good ones over 0.4. Okay. But there are other ones out there that, basically they just own a bunch of mutual funds. So it's, I'm an advisor charging you fees to manage your money, and then I'm going to hand it off to somebody else to charge more fees and manage your money. Okay, I've always talked about mutual funds that way because that's essentially the same thing, right? You have an advisor that is managing your money by giving your money to other people to manage. So there's two layers of managers in there, two layers of management fees. And the worst thing is I've seen SMAs and mutual funds that own other mutual funds. Can you imagine an SMA, a separately managed account that's just filled with a bunch more mutual funds? So now you got 3 layers of management fees. So please be careful and make sure that we're using the correct types of investments. They are what they are and are not looking at your big picture. Okay, so this is important. So when we talk about a separately managed account, and that's why this is hard, because if you have a good advisor, theoretically, isn't that what you're paying them to do? Okay. And again, I am an advisor and I have recommended these here and there, but it's always for very specialty investing situations so that I'm comfortable with and understand that it's great to have somebody that only specializes in that one little thing, that one niche. And the power that they have in doing that is fantastic. So there are reasons for this. Okay. But these SMAs, they don't really know that much about the bigger picture. They were just told they needed this type of investment portfolio, and they're tasked with managing that specific investment portfolio. So understand that there still needs to be somebody looking at the big picture. That can be you. I don't have a problem with that. That eliminates that other advisor fee. And look, I do this hourly as well, and some people are do-it-yourselfers, and sometimes I'll recommend these in certain circumstances because you won't really have my layer of fees in there, but yet I'm still there to help and guide and help be that quarterback coordinating the big picture. So look, sometimes these are useful, sometimes they're not. Sometimes, I look at these and they just make you think they're investing the money. I've seen plenty of the big box shops out there. So their advisors have turned into just salespeople, and that's it. Because all your money is going into SMAs. Okay, and I'm not going to use names, but the big box shops that are out there, that's more and more what they're doing. They don't want the individual advisor managing your money. They want to manage the money for their advisors. Okay, so they're just putting them into these separately managed accounts, and these big companies are really doing all the investing and managing and choices of anything in there. So be careful about it. There's good and bad out there on all of that. So hopefully that demystifies what an SMA is, a separately managed account. It's kind of like your own little mutual fund account. It can be useful. I've seen, for instance, an SMA of the S&P 500 way outperformed all the indices and the ETFs and mutual funds because it didn't rebalance. Those are some of the good things. When those top 7 stocks got heavily overweighted, they just kept growing and growing and growing. Well, a lot of the ETFs and mutual funds were rebalancing to the true balance of the S&P 500 index. And some of the SMAs decided to ride the wave, and they grew a lot faster. And so there's a lot of choices like that you can make out there. All right. I hope that helps your investment counselor. I'm happy to meet with anybody for any reason. Got a free meet and greet on there. I'm certainly happy to work hourly. Whatever people need from me, I'm always happy to help. Yourinvestmentcounselor.com. FPFEAZ.org. I do classes, full form classes on Zoom live. You can jump on and enjoy the classes, ask questions, all those wonderful things. Go to FPFEAZ.org to find our schedule for our full classes, and certainly give us a call if we can help out in any way. If you haven't found the full channel, there's over 200 videos. We're almost at 10,000 subscribers. Hit subscribe, hit like, and I will see you next week with the next video. Thanks again.